So today we are going to look at avoiding rookie mistakes. What are some common mistakes that people who are just who just started trading stocks, what mistakes do they commonly make and how can you avoid those? So the agenda for today Here's the agenda for today. Like I said, we'll talk about avoiding rookie mistakes. We'll have a demo. I wanted to have a demo last time. We did not get chance to do it. We'll have a demo today. And since we are learning here, we are going to have homework. I'm going to give you homework today that needs to be done before the next class. So again, this webinar is brought to you by Ivorian LLC. We offer personal finance training, or consultation. We offer IT training, technical interview prep, and our website is ivorian.com and ivorian.com/finance. You can reach us on YouTube as well. You can look at our channel. Please subscribe, like, and share our videos. Okay, so as we all know, Ivorian Investment Club, we meet, it has free membership. We'll be talking about stock market, but not just stock market. We'll talk about financial literacy, investment, and things like that. We'll meet monthly. Our next meeting will be on October 12th. But what I want to do is that from November, I want us to pick a specific day or Saturday of the month, so that it will be easier for people to remember that, okay, there is a meeting. So we're going to transition to the first Saturday of the month, starting from November. I hope that works for most people. If there's a need to change that, we'll do that. Again, people have to sign up to be notified. And as I always say, please spread the word. There are people out there that are looking for that would love to invest, but they don't know how to go about it. So please spread the word, let people know about this club. Okay, so let's go into before we go, does anybody have any question from the last time? Anything that is not clear from the last time we met? Okay, if there's nothing, let's go into the main thing the main agenda for today. Common mistakes rookies make. When you're just, even babies, when they try to start to walk, they fall, but with practice, they eventually learn to walk. Work is the same thing when you're investing. You will not know everything at once. You keep learning, even though no matter for how long you've been investing, you still keep learning. You should keep learning. You should, like, there are still things that you see that, oh, maybe I've been doing something this thing this way before. Let me change to this way. So now I want you to all to learn from other people. I put together some common mistakes that people make when they start to invest. Some of these mistakes, I made them as well. If you have already made some of them, it's fine. You can just make sure that, okay, going forward, you know what to do. And if you are yet to make any of these mistakes, this is a guide for you so you don't make such mistakes. The first thing is lack of research. Many people just start to invest without doing research. They invest in stocks without doing research about not just stocks, like different assets, without knowing much about the stocks or the asset that they are trying to buy. It's important to actually do some research before you decide that, okay, I'm going to invest in this stock. You want to understand the fundamentals of the company. You want to know the financial health of the company before you invest in it. Is the company doing good? Are they running at loss? Who are the management? Are they managing the company well? What industry is the company? What are the products that the company builds? Some of the mistakes I made when I started investing was I bought stocks of companies I did not know about. I just saw maybe on MSNBC or something like that. Or yeah, I would just see one stock, and I'll buy it. And some later, like, okay, maybe the price went down or something like that. But you don't want to just pick a company just because you saw a stock somewhere. You don't just want to invest. You want to make sure you do the necessary research. Doing research, the outcome of your research will tell you whether or not to buy a stock. Or if you have already bought it, further research will tell you, oh, sell it now or buy more of it. So it's very important that you don't just invest haphazardly. You want to do necessary due diligence before you invest. Then the second mistake is emotional investing. Sometimes people invest based on emotions, based on greed. Like, oh, they just want to, that stock that has gone up like 400%, they just want to invest it. Or people just make poor investment choices. Sometimes it's a fear of missing out. They hear that, okay, maybe one stock is is doing well, and they just don't want to miss out of it. They just go buy it without doing the necessary due diligence. Now, it's important to stay rational, and this is important when it comes to selling stocks. Maybe you have already bought a stock, and the price is going down. Many people will just panic and go sell the stock. In fact, one thing I've noticed is that even when the whole market is not doing well, people forget that it's the whole market that is not doing well. They just focus on that single stock that they have bought, and now the price has gone down, and they panic. They go sell the stock. You want to make sure that you stay rational. You don't just because there's a downturn, just because the market is going down, or even a specific a stock, just because the price has gone down does not necessarily mean you should sell it. Does that mean you should never sell your stock, especially when the price has gone down? No. I have some stocks that I've sold at loss. But before I sell a stock, I look at the necessary things. I do my due diligence. Here's an example. There's a stock called Meli. Meli is like the Amazon of South America. I bought the stock and then it started going down. I was running at loss on it. I wanted to sell it, thinking that, oh, maybe this stock is not going to bounce back. Let me sell it. But usually before I sell a stock, I look at the chart. What is the chart telling me? So I looked at the chart for Meli, and with the chart, I was able to discover that it will bounce back. So I decided to leave it. Now the price has gone up again. I'm no longer having loss on that stock. So it's important to not just rush or panic to sell a stock. The next mistake is not diversifying. Many beginners just put their money in a single stock or in a single sector. By so doing, they are putting their investment at a great risk. Because that one stock that they have invested in, for whatever reason, the price can go down. The company might even fold up. An example is I invested in SIVB, and the bank folded up. All my investment is now zero. If that were to be the only stock I invested in, I would have put myself in a lot of trouble. So you don't want to invest in a single stock. You don't want to invest in a single a single sector. You want to diversify. You want to have multiple stocks. You want to invest in multiple what's it called, sectors. one of the mistake people make is that, okay, they will say they are diversifying, but all of their stocks will still be in one sector, maybe like technology, for instance. Technology is doing well, but anything can happen that the whole of technology will just not do well. If that's the only sector you have invested in, you are putting your investment at risk. But instead of that, you want to invest in multiple sectors. You want to invest in multiple stocks. In actual fact, it is recommended to invest in like ETFs and mutual funds. ETF stands for exchange traded funds. They are like basket of stocks. So that if you invest in an ETF, for instance, if one of the stocks in an ETF goes down, if the price goes down, the overall effect on the ETF may not be that significant. But if you have just invested in only that stock, your investment, or the value of your investment will go down. Apart from investing in multiple stocks, multiple sectors, another way you can diversify is to invest in multiple investment products. Stocks is not the only thing you can invest it to build wealth. You want to try things like bonds. You want to try CDs. CD stands for certificate of deposit. You want to try money market. You want to try high-yield savings accounts. If you go to Ivorian channel, I have a video on CD, certificate of deposit. I have another video on brokered CD. If you watch the videos, you will learn more about them. So another thing is chasing trends. So you hear about market trend, you hear about hot tips, especially if you go on, I forgot the name of this social media, I forgot the name of this social media. Yeah. You just hear that, okay, one stock is going up, like the price is going up, and you just invest in it. I'm not saying that you
Reddit.
shouldn't. Reddit, thank you. Reddit. So you just hear that, oh, on Reddit, people are talking about one stock on Reddit, and you just go invest in it. Chasing trend does not end well most of the time. A few years ago, there was GameStop, there was AMC, that people just because they started talking about it on Reddit, people started investing in it, and many people lost money. In actual fact, there's this guiding principle I have. When I was in college, I participated in an essay competition, and the topic I wrote on was, when you see a bandwagon, it is too late. This is the literal interpretation of that, or explanation of that. Look at bandwagon. Bandwagon is like you've heard of caravans, like when people are, let's say, people are trying to migrate illegally into a country, they are in a caravan, like you see many people coming at the same time, So when you see a caravan, it's already too full. By the time it gets to you, you see it coming. By the time it gets to you, it's already too full. You can't even join it. But you see a truck, maybe there are just few people there. You join at that time. As time goes on, when it becomes a caravan, when it becomes a bandwagon, you are already part of it, right? That's better than trying to join when it's already a bandwagon. That helps me in investing as well. Usually when you only buy stocks because people are talking about it, you put your investment in jeopardy, because there's a reason that it starts to go up. There's a reason that maybe people are talking about it. And when people realize that this investment or this stock is overvalued, people will start to sell it. And if you are not so lucky to sell on time, you will record a loss. So you don't want to buy stock just because people are saying that, okay, it's the price is going up. You want to find out, why is the price going up? Is it because Elon Musk just tweets something? It happened sometimes ago that Elon Musk tweeted something, and one of the things, there was something that looked like a ticker symbol of a company. That was not what he was referring to. He was referring to something else, but it was a ticker. It happens to be the ticker symbol of a company. And that day, people started buying that stuff. If I remember correctly, it went up as much as 400%. By the following day, when people realized that it wasn't talking about that stock, people started selling. Again, you can, if you are not fast enough to sell it, you can record loss. The next mistake is to ignore fees. Sometimes when people invest, they just think that, okay, they invest in a stock, they make there's this thing that people will say, buy low, sell high. It's not as easy as that. We'll talk about that cliche later, but it's not as easy as that. Think beyond just buying low and sell high. Think about the fees involved as well. For me, I will never use a brokerage app that charges commission. You have to think about what are the commissions charged by your brokerage app before you start to use it. These days, thank God, there are many brokerage apps that charge 0% commission on stocks and ETF. But that's not the only, commission is not the only charge or the cost involved. Apart from that, there could be, if you buy foreign stocks, there could be something called ADR custody fee for foreign stock. Usually, it's a very small amount. If you buy index fund, there's usually an expense ratio. Some other funds will charge administrative fee in addition to that. You have to consider all of those before you invest in stocks. Especially if you are investing in index fund, look at the index funds that have zero, what's it called? Low expense ratio or zero if possible. Another mistake is ignoring taxes. Again, many people would think they just invest, they sell the stock, they get the money put in their pocket. No. At the end of the year, your the brokerage firm would send you 1099 form that sells, like, okay, the stocks that you bought, you sold, the profits you made from me, and then you use that when you're filing taxes. Taxes for capital investment, capital taxes may be a little bit complicated, but it's not something you cannot learn. The way your investment, and before I continue, there's a concept called realized gain and unrealized gain. Realized loss and unrealized loss. When you hear somebody saying that, oh, I'm making profit on a stock, that's not the whole truth. And this is what I mean. You buy stocks, let's say a unit of stock is selling for 100. You buy it at 100. Later, some months later, it becomes 150. For every unit, you have made a profit of $50. Right? Now, all of the $50 will not go to you. You have to buy, actually, the profit until you sell the stock, whatever profit you see. So again, you buy it at 100, it becomes 50. That's called unrealized gain because you are yet to sell the stock. Anything can still happen. That gain can be reduced, can be wiped off if the value of the stock goes down. Again, you buy at 100, it goes down to 80. That's an unrealized loss. Many people just panic and go sell like that. Anything can happen. The value of that stock can increase later. And then the unrealized loss turns to unrealized gain. Now, by the time you sell your stock, unrealized gain becomes a realized gain. Unrealized loss becomes a realized loss. It is that realized gain or that realized gain that you pay taxes on. And the taxes you pay depends on at least 3 factors. Number one, the holding period. For how long did you hold the stock? It can be short term, or it can be long term. Short term holding period is when you buy stock and you sell it within 1 year. That's short term. When you buy and sell stocks over a period of longer than 1 year, that's a long term holding period. The way your stock is, the way your profit is taxed, the difference between when, if it's a short term, what's it called, gain or long term gain. Another thing that could also affect your gain is your taxable income and also the type of asset. For example, there's some what's it called, the way your dividends will be taxed would depend on, like, okay, is it a foreign company that gave you that dividend or a US company? So all of those things have to be considered when investing in stocks. Then timing the market. Some people try to predict the market. Oh, this will happen. The stock market will do this, do that. For more than a year, people have been saying there will be recession, and there's not been recession. In fact, last year, there was this organization that was saying that they mentioned a specific day in September of last year. They said 12 noon, the market will crash. It never happened. You might be able to predict certain things. That doesn't necessarily mean that all the time you'll be able to predict, you'll be able to say what will happen. So rather than timing the market, a better approach is to invest consistently. For me, every time I get paycheck, a portion of my paycheck goes into investment. In fact, I don't see it. I automate my finance. And later on, we'll talk about personal finance. I automate my finance. A certain percentage of my income goes into my robo investment every single month. A certain percentage goes into my high yield savings account every single month. I don't see it, but it gets transferred. So there's nothing like, oh, maybe I will spend it or something like that. That is how to be consistent when it comes to investing. So rather than timing the market, investing consistently over time is the better idea. Then another mistake is lack of clear goals. Why are you even investing in the first instance? Are you investing because it's just a good idea to invest, or because, oh, Temitayo said invest? Do you have clear goals? In the demo, I'm going to show you my account. You see that I have in my in one of my brokerage accounts, you see that I have different accounts in one of my brokerage apps. Each account has a purpose for which I opened it. Your goals will determine what you do. Your goals, in actual fact, people confuse investing and trading. People use them interchangeably, but they are not necessarily the same thing. Investing is when you are buying, let's say you are investing, you are buying, you put money in an asset, hoping that the asset will grow over time. Or in the case of stocks, that in addition to growth, you will also get dividend. So you are putting money in an asset for a long time. That's investing. Trading, on the other hand, is when you are trying to leverage the inconsistency in the value of an asset. Again, the concept of buy low, sell high. You think that, okay, it's going to rise at a time, it's going to fall at a time. So you buy when it's low, you sell when it's high. That's trading. Your goals will determine whether you are trading or invest. You actually have to determine, am I trading or am I investing? Am I investing for retirement? Am I investing for future? Or do I just want to make more money now? I just want to invest. I just want to trade. That will determine certain strategies that you are going to employ. It will determine whether or not you are going to use technical analysis. Well, that will be there. If you are investing for future, you really don't need technical analysis. Fundamental analysis will be sufficient. We'll talk about all of those later. So in short, you have to determine your goals. You have to determine your investment objectives, and you have to determine the time horizon for investment. Those will determine the strategies you use. Then, ignoring risk tolerance. You have to determine how much risk you are willing to bear. Usually, investment is all about risk versus return. The higher the risk you are willing to take, the higher the returns, and vice versa. So you have to determine how much risk you are willing to take. One of the questions that was asked last time was that, are we going to talk about cryptocurrencies in this program? I said no, because I don't invest in cryptos. And why do I not invest in cryptos? It's beyond my risk appetite. The way it fluctuates, I cannot bear it. So you have to determine, and that even investment in stocks has its own risk. There are things that I can do that may not be advisable for some other people that don't have the same level of risk appetite that I have. An example is this. Nvidia has been going down for like, most likely if you just bought Nvidia, let's say in the last 1 or 2 months, most likely you are losing money on it. And you may not want to buy more of it. For me, I'm buying more of Nvidia, even though the price is going down. That's the level of risk I'm willing to take. Because I know it's a good product. I know that, okay, even though it's going down, I know that the company is still doing well. It's going to, the price will rise again. But somebody else may not be able to take that kind of risk I'm taking. And one of the reasons, apart from the fact that I know it's going to go up again, one of the reasons I'm willing to put in more money in it is that I started investing in Nvidia some years back when the price was really, really low. So even if I lose some money here, when it comes to Nvidia, I'm still gaining money. Even if it goes down more and I lose my money for the recent investment I have in it, I will still be making money on Nvidia. So you have to determine your risk appetite. That will determine the kind of investment. What are you able to tolerate? What kind of risk are you able to? That will determine that, okay, are you using an aggressive approach? That will determine, you have to determine that. Then the next thing is overconfidence. Maybe in one of your accounts, you've already, what's it called? You are beating S&P 500. That doesn't necessarily mean that you should just be buying every stock you see out there because you are doing well. And it's also important to stay humble. You might think that, oh, you know it all, your stock is doing well, your portfolio is doing well, you know so many things. It's important to learn from people. Even though I'm teaching about stocks and investment right now, I still learn from people. If I see one webinar or something, I will still attend if I have time. I still read books on investment. So don't be overconfident. Just because your portfolio is doing well, don't be overconfident. Keep educating yourself. Then the next thing is not having an emergency fund. In building wealth, in fact, if you go to my YouTube channel, I made a video on attaining financial freedom. And I said that the very first thing you have to do to attain financial freedom is to have an emergency fund. You don't want to invest when you don't have an emergency fund. That's like putting the cart before the horse, or is it putting the horse before the cart? I don't remember how they say it. The horse should be before the cart. Yeah, that's like putting the cart before the horse. The first thing you need to do is to have an emergency fund. It's recommended to have 3 to 6 months of expenses in an emergency fund, just in case something happens. You might be driving and then you drive on nail, you puncture your tire. God help you that it's a luxury tire, it's a luxury car, and they tell you to bring 500, 1,000 for a single, what's it called? A single tire. If you don't have an emergency fund, you're not going to be able to drive. There are things happen, life happens. You need to have an emergency fund before you start to invest. In actual fact, I tell people never invest the money you need in the next 1 year, because you never can tell what will happen. Then the next thing is borrowing to invest. So you bought one stock and the price is going high, you are making profit on it, and you think you should invest more, but you don't have money. You think, oh, let me just borrow. I'll borrow, invest in this stock. In like a month's time, I will sell the stock and I'll make a lot of profit and I'll pay the person back. It doesn't always happen like that. This happened to me. I one stock that was doing what that I had, I wanted to invest more, not just one, a few of them. I wanted to invest more. I borrowed money from my brother. And immediately I used the money to buy more stocks, all of them started coming down. I think I promised him I was going to give him back in a month's time. And the value started going down. Thank God I was able to get the money in another way, elsewhere, right? I was able to make money and I was able to like, okay, give him back. Otherwise, if I depended only on that stock, I would have had to sell them at loss. So one of the key things, never ever borrow to invest. An exception is this. There is something called margin. We'll talk about that later. People within your brokerage, that people use borrowed money to buy stocks. Again, I still do not do that. I have a margin account, but I've never borrowed in it, and I will never do. But it's still better than, again, even though I said I don't even think it's better, because you can lose money. If anything can, I think it's just the same as borrowing money from people, honestly. Then the last thing I have here is ignoring past performance. While past performance does not necessarily guarantee future performance, it's important to look at how a stock has been doing in the past before you decide to invest in it. And I'm going to show you this in a, let me bring up something. There's something I do before I invest. I always look at the performance in the last 1 year before I decide if to buy a stock. The problem is that even that approach, you might still make the wrong judgment with that approach. Look at this. And by the way, this is not real. This is a paper trading. So when you're looking at a stock, you see something called 52-week range. That shows you the lowest price in the last 1 year, in the last 52 weeks, and the highest price in the last 52 weeks. I always look at this before I invest in stock. But there was one mistake I used to make when I first started investing in stock. And that was like, looking at this, I was saying, oh, this one is so close to 50, or this one is already like at the 52-week high. Okay, it's not likely to go up again. Let me buy this one. Okay, it's closer to the 52-week low. The fact that it has gone high to 231 before means it will likely go up again. That okay, let me buy this. It can go from whatever value it is now to this, since it has been there before. That was the judgment I used to make, but that's a wrong judgment. Over time, what I figured out, why it is possible that okay, a stock that is close to 52-week low can eventually rise in price. Most of the time, the stocks that are closer to 52-week high, they do better than the stocks that are closer to 52-week low. Because come to think of it, there's a reason that the price of this stock has fallen from 231 to the price it is right now, 178. Maybe they are all of a sudden, maybe they're not doing well again. And maybe that most of the time that trend will continue. So a better approach when you're looking at past performance, a better approach is to invest in stocks that are as close to the 52-week high as possible, rather than the ones that are closer to 52 weekly. That doesn't necessarily mean that this is the only thing you look at when investing. You look at this, you look at some other thing. But what I'm trying to say is that it's important to look at past performance, and also the stocks that are closer to the 52-week high, they always do better than the ones that are closer to 52-week low. Okay, we have 15 minutes left. There's a second part of today's program. I'm just going to rush through it, and um, we will go over them again in subsequent sessions. I will have a demo. I said last time that somebody said I should show you how to sign up for brokerage apps. So last time I gave you some common brokerage apps or brokerage firms: Fidelity, Weibo, Charles Schwab, TD Ameritrade, Robinhood. I gave you that list. So I'm going to just show you how to sign up for Fidelity. So go to Fidelity. Go to fidelity.com. The moment you get to the home page, you see open account. Just click open account. You have different accounts here. The right one is the brokerage account. So you click open now. Then it's going to ask you, is it just for you or is it joint account? If you are opening with your spouse or something, you can use this one. I'll share it. If it's just for you, you can click just for me. Click next. Well, this is loading. Let's go to Weibo. Okay, so it's going to ask you this: where will you keep where will your cash be held? So the way it works is that when you have a brokerage app or brokerage account, you need to link it with your bank account. So you can transfer money from your bank to the brokerage account, and then you can trade stocks. Now, Fidelity is asking you where you want your cash that is in the account that you have not used to buy stocks. Where do you want it held? These are two options. I always choose this first option rather than the second one option. And as you can see, the 7-day yield is 4.9 for this one, and the rate for this one is 2.69. So I always choose the first one. So next, now you're the Fidelity customer, you click no rather. You type your name. what we saw earlier where it was asking where you want to put your fund, it will eventually appear later after this. But here you have to put the necessary details. You have to put your name, social security number, address, and everything. You click next, and then it could ask you a few questions, especially where you want to keep your fund. It will ask you that. For Weibo, again. Again, you click sign up, you enter your phone number, then you click send code. As soon as you enter your phone number, this one will be highlighted. It will send a code to you. Then you enter the code it sends to your phone, and then you click next. It will ask you your name, your address, social security number. It's important. It's going to ask you both. I mean, brokerage firm will ask for your social security number. It's fine. You have to give it to them. So that is it. Let me give you, we still, okay, within 10 minutes, let's see if anybody has any question, I can answer that. From next time, I will show you the interface of Weibo, interface of Fidelity. I'll show you that, but let's just spend the remaining minutes to talk about, to answer any question.
So I have a question. So on one of the bullet points you have for mistakes that people make, there's one that had too much diversification.
Oh,
Yes. Can you speak? Because it sounds to me like too much diversification would be sort of like a safety net. Is there something like, can you say more to this?
yeah, thank you. And I'm not sure why I jumped that. Yeah, you can diversify too much. So remember, I said when I was talking about diversification, I said that you don't want to buy just one stock or just one sector, right? Because if something happens to it and the value goes down, your investment will be at risk, right? So that's why I said diversify, buy multiple stocks or buy ETFs. And in actual fact, some people will say that never buys individual stocks, always buy ETF. Well, it's okay. Each person will determine what works for them. For me, I buy ETFs and I buy individual stocks as well. But coming back to your question, now you diversify by investing in multiple stocks or ETFs or in multiple sectors. But you can also overdo it. And I actually, when I started trading, I overdid it. In one of my brokerage accounts, I have more than 90 stocks that I bought then. Uh, Later on, I discovered that was a mistake. You don't want to buy so many because do you even have time to be researching each of those ones to be sure that it's a good one before you buy it? Probably I didn't, as at that time I didn't know much. I did not really do any research. I was just buying it, and that was a mistake. And in that account where I have over 90 stocks, I'm actually running at loss. That account is negative because I was just buying stocks, buying stocks. Right. So you buy over too much diversification, I mean buying so many stocks. You want to have like a bucket, a list of some stocks that, okay, you have done your research, they are doing well, you want to focus on, rather than buying just any stock that comes your way. That's what I meant.
Thank you.
You're welcome. Any other question? Questions, thoughts, or suggestion of what you'd like to see in the future, what you'd like me to talk about. Just, we have 6 minutes. Any thoughts?
So I'm also hoping you will in the future talk about this topic on ignoring taxes. You've talked about profit realized, not realized. There was just a lot of information there that I don't think I fully grasp what you were saying there. So if that could be incorporated into the future, because I assume that at some point we'll have to deal with selling for whatever reason, and one has to be well informed.
Yeah, definitely. We'll talk about taxes. We'll talk about that. Maybe we'll have one session that we'll talk about it. Maybe even, yeah, maybe one session we'll talk about it, how you'll be taxed. Yeah, we'll do that. Any other question, thoughts, anything you'd like us to talk about? And
Um,
please, go ahead.
so let's say, maybe also talk about, I mean, you can do an investment on a company, but what information do you consider in making your decision as to whether you should invest in that company? Like, how do you know what a good company is or not? So, talking about those, where do you find the information? Because the company can be seem to be doing well today and then, may not be doing well tomorrow. So, like, how do you choose those companies for long-term investment that you know that over the long term they'll remain good, good investment choices?
Yeah, yeah. So I have a plan. I have some things that I know we are going to talk about, and one of them was what you just said. That okay, how do I know if I should invest in these stocks, or how do I know if I should sell what I already have? I'm going to talk about how to know about that. You can do the research yourself, or you can subscribe to maybe some you can have subscription of people who have already done all that companies that have already done research for you that okay they will tell you buy this but okay yeah let me give you one example. We'll look at this is Active Trader by Fidelity, and one of the things they do is every day they recommend the stock. So this was what they recommended yesterday. They've done an analysis of this company and they recommended, okay, buy this. So there are companies that specialize in that. Some of them free, some you have to pay for the subscription, right? But you can also do it yourself. We'll have sessions, not even one session. We'll have sessions, multiple sessions on doing research. We'll talk about fundamental analysis. We'll talk about technical analysis. How do you look at charts? What are the things you have to do? Maybe like moving average, things like that. What are the things you look at to determine, oh, should you buy this stock? Should you sell? We'll talk about all of this.
And just to quickly add to that, if the research side of things overwhelm you, like Tayo said, there are companies that they are like actual companies that's what they specialize in. Like I'm personally subscribed to the monthly full. If you have the money, I would say it's paid me more than 100 times the money that I've spent subscribing to them. I think that their least subscription is about 200 and something per year, and it's called the stock advisor or something like that if the money hasn't increased. So every single week we get buy recommendations and they will give you a detailed analysis of why they're recommending that stock. We get sell recommendations for stocks that they recommended in the past but they're not doing well anymore for you to sell. And we get penalty box recommendations. For example, recently they just put CrowdStrike into the penalty box. That's stocks that they're not really sure of their future. They think you should be careful. If you already have it, don't sell, but don't buy more. So things like that. It's very, very overwhelming to be researching every single stock before you
Yeah.
buy. So yeah, paid subscriptions are really good. Yeah.
Yeah, thank you so much. And in my language, they'll say you use money to get money, right? She just said the subscription is 200. You can think, oh, that's a lot per year. But if you think of how much money you can make in the stock market, you know that that's a peanut. Any thoughts, any questions before we end the session for today?
Okay, I believe you're going to send us the recording after now.
Yes.
Okay, just wanted to confirm that. Thank you.
Yes. You're welcome, sir. Okay, for those that did not start with us today, I said the next meeting will be October 12th. But starting from November, we'll be meeting on the first Saturdays of the month. And I hope that works. If that doesn't work for you, please let me know. And if it doesn't work for the majority, maybe we'll look for another Saturday. But I just thought it's a good idea to have a consistent date that we'll be meeting. And I hope you learned one thing or the other from today's class. Again, please share the words with people. Let people know that this opportunity to learn about investing exists. And if you know something that you would like to teach us, please talk to me. I don't have to be the only one talking or teaching all the time. If you know something about investing, anything that we can do to make money, please talk to me, and I can give you I can let you talk to teach us. Again, I've been saying this. I've not decided what platform I'm going to use, but I think we should have a platform where we can communicate in between our monthly meetings, maybe WhatsApp, maybe Slack or something. I'm still indecisive. I don't know which of the two to use, but that will be communicated as soon as a decision is made, so that if somebody has any thought, anything you want to share with us in between the meetings, any investment opportunities or anything you have done that you think is going well, any trade you've done that is going well, let us know. So, all right, thank you, everyone. Thank you for joining. Oh, I first thought I did not record. Okay, I'm recording. Thank you for joining us today.